With savings accounts offering rates of 5% and above, why would I want to invest my money in anything else? Yes, the stock market is known for producing higher returns over the long run, but lately it's been disappointing and shows no sign of improving. So why bother? This is a question that we've been getting from a lot of our clients recently, and I'm sure you've been thinking the same thing because it's a good question. But it tells me two things. Number one, you've lost sight of the goals that you are trying to achieve. And number two, you don't understand what typically happens to stock market returns when interest rates are high. The temptation to hold cash right now is strong. But if you understood these things, you'd realize that holding cash will likely jeopardize your ability to retire with the lifestyle that you want. Hello and welcome back to the channel. If you're new here, hi, my name is James. I am a financial planner, and this is a place where you can learn to make smarter financial decisions. Cash is great for an emergency fund or a cash buffer in retirement. For these use cases, cash is really important, and the fact that rates are high is a good thing. What we're talking about today is anything beyond that emergency fund. Money that you know that you won't need for the long term, for 10 plus years. Although cash account may seem like the safest place to keep your money, over long periods of time, it's actually very risky. Let me explain. The reason why we save money now is so that we can spend that money at some point in the future, typically at some point in retirement, perhaps 10, 20, or 30 years into the future. Here's Ben. He's 50 years old and he wants to retire at 60. So Ben is saving money now to create an income for himself in retirement. Although he plans to retire in 10 years' time, he's only going to need to draw down on a small part of his savings in those first few years of retirement, which means that the majority of the money that he's saving now is going to need to remain invested and continue working for him for perhaps 20, 30, or even 40 years from where we are today. So although Ben is close to retirement, he is still very much a long-term investor, and he needs to find somewhere to park his cash. With this, he's looking for two things. Number one, he wants to make sure that his money at least maintains its purchasing power, as in it holds its value in line with inflation, because there's no point him saving £100 today if when he goes to spend that in 20 years, it can only buy him £50 worth of goods. And number two, rather than just keeping pace with inflation, he wants his money to grow as much as possible, because the more that his money grows, the less he needs to save to achieve his retirement goals. So let's look at some options for Ben. What if he just stuck his cash under the mattress, the safest place to keep your money? If he did this with £100, he will always have £100, never less, never more. Over 1 or 2 years, that may be fine. But if he'd done this over the last 20 years, his £100 would only buy him £57 worth of goods today. So from Ben's perspective, not only would he be losing money, but it would also mean that he'd have to save a hell of a lot more if he ever wants to retire. So for him, keeping his money under the mattress is a very high-risk option because it's almost guaranteeing that he'll never be able to achieve his goals. But come on, James, very few people would actually ever do that. Well, maybe not under the mattress, but lots of people keep money in bank accounts that yield less than inflation. For the last 15 years, that's been pretty hard to avoid, as even the best savings accounts rates have lagged well behind inflation. Even now, with inflation in the UK at 6.7%, the best savings accounts are still losing you money. But the last 15 years have been somewhat of an anomaly. In the past, you used to be able to get decent real returns on your cash, and it looks like things might be starting to change. In the US, inflation has fallen to 3.7%, meaning you can now find cash accounts with decent real returns, and the UK might be close behind. In fact, if we look back at a comprehensive global data set that spans the last 130 years, over a 20-year period, cash has, on average, yielded more than inflation. On average, if you'd put £100 into the equivalent of the most competitive savings account, after 20 years, you would have £114 after adjusting for inflation. So perhaps we're about to see a return to normality and cash may, in the future, keep pace with inflation. But looking at averages can be misleading because they hide the variability of results. These pink bars represent the 25th and 75th percentiles of historical scenarios in this dataset. So in the top 25% of historical scenarios, cash returned £150 or more, whereas in the bottom 25% of scenarios, it returned £84 or less. The tail bars represent the 5th and 95th percentile. So in the worst 5% of scenarios, you had been left with just £28 or less. That's a 72% loss of purchasing power. And remember, that's assuming that you continually keep your money in competitive savings accounts. But most people don't do this and would likely have seen even worse results. To put the last 20 years into this context, if you put £100 in a competitive savings account 20 years ago, it will be worth just £74 today, which is in the bottom 20% of results. Looking at data this way helps us to see that even though, on average, cash has kept pace with inflation, there is a lot of variability in that result. Another word for variability is risk. Cash feels safe because it holds its nominal value and is seen as a haven for risk-averse people. But when you view it through the lens of the goals that you are trying to achieve, you realize that it's actually pretty risky. This is a really key point. Whatever you do, even if you do nothing, especially if you do nothing, you are taking risk. But how does this compare with stocks? On average, over a 20-year period, £100 invested into the global stock market would have turned into £278 after adjusting for inflation, which sounds good, but as you now know, we need to look at the variability of that result. As expected, the range of outcomes is much wider. In the top 25% of scenarios, you would have been left with £466 or more, but in the top 5%, you would have ended up with more than £969. Clearly, investing in stocks has a lot of upside potential, but what about the downside? The 25th percentile comes in at £170, whilst in the bottom 5% of scenarios, you would have been left with £82 or less. So what does this show us? Yes, stock market returns are more variable than cash. Variance is another name for risk, which is why we say that stocks are more risky than cash. But from Ben's perspective and the goals that he wants to achieve, which of these appears to be more risky? Forget for a moment that we're looking at stocks and cash and evaluate these as two unknown investment options. Option B has beaten inflation in 92% of scenarios, whilst option A has failed 37% of the time. And when it has failed, it's done so by a much greater degree. What's also missing from this data is that the majority of the scenarios where stocks failed to beat inflation, cash did even worse. And when it comes to the potential for capital growth, well, there's obviously no comparison. With all of this, I'm sure you'll agree that from Ben's perspective, holding cash is far more risky than investing in the stock market. So the answer is simple. If Ben wants the best chance of achieving his goals, he should invest his money into a globally diversified stock market index fund, and then forget all about it. He should never look at his investment account balance until he's retired, because why does he need to look? He's already set himself up for the best chances of success. If he did this and he never looked, this would give him the highest chances of achieving his retirement goals, and it would be completely painless. But unfortunately, Ben is not a robot, and he checks the value of his account every week and is continually getting distracted by what is happening with the stock market in the short term, which is easy to do. Last year, the US stock market fell by 18%, whilst cash returned 2%. Last year, cash beat stocks, but that's not uncommon. In the US, over the last 95 years, cash has beaten stocks 35 times. That's 1 in every 3 years, and sometimes it's happened for 2, 3, or even 4 years in a row. As we've just seen, over the long term, investing in the stock market is the least risky option that is going to give Ben the highest chances of success. But in the short term, it can be very volatile. And if he can't stick with it, well, he's never going to see those long-term results. If Ben keeps checking his investment account and comparing his short-term returns versus cash or other investments, he's going to be tempted to try and time the market and speculate which is going to perform best in a given year, which is going to be damaging not only for his investment health, but also for his mental health. But I know what he'd be thinking. Surely, now that interest rates are high, it's going to be much harder for the stock market to outperform cash, at least in the short term, right? Well, let's think about that. Over the long term, global stocks have achieved an average annual return of about 9%. But now that you can get a guaranteed 5.5% return on your cash, that potential 9% return on the stock market is not looking as attractive. But what do you think would happen if interest rates were at 9%? If this happened and the stock market was only ever expected to deliver a 9% return, well, obviously no one's going to invest in it. So clearly something has to change. Let's do a little thought experiment. Say that inflation is running at 7% per year and interest rates are at 9%, meaning that you can get a 9% risk-free return by keeping your money in a savings account. What level of return would you need to expect from the stock market for you to invest in it? 9%? Well, obviously not. The stock market is riskier than keeping your money at the bank. So we would need to expect a premium above this to encourage us to invest. So what premium would you need to expect from stocks to take on that risk? I asked you this question in a poll almost a year ago, and these were the results. As expected, if you can get 9% in the bank, most people would demand a much higher return from stocks for taking on that risk, with 13 to 15% being the most popular option. Let's call it 14%. So on average, as a collective, as a market, you would demand a 5% expected premium above what you can get in the bank for taking on the risk of the stock market. What's fascinating about this result is that if you look back over the last 100 years, the premium that stocks have delivered over cash is about 5%. And as you can see from this data going back to 1900, the higher interest rates are at the start of a period, the higher the return that stocks have delivered for the following 5 years. So instead of thinking about the stock market as something that delivers a 9% return on average, a better way to think is that it is always priced to deliver an expected premium above what you can get on your cash. This is known as the equity risk premium. Of course, that premium may not materialize in the short term, but that's the risk that we take on. And that premium will vary depending on how much demand there is for risk. If you go back to 2021, when the stock market had been performing really well and you could get almost nothing on your cash, how many times did I get asked this question? Not once did anyone ask me whether cash would be a better investment than stocks, because everyone was feeling very risk on. Everyone wanted to invest in the stock market. But the problem is that when there is so much demand for risk, so much demand for stocks, it pushes up prices, which seems good in the short term, but it actually reduces future expected returns. And look at what happened afterwards. Whereas where we sit now, the stock market has been pretty disappointing over the last 18 months, and you can get a 5% return on your cash, which makes cash look a lot more attractive. This means that people are less inclined to take risk. And if there is less demand for risk, this has the effect of pushing up the expected returns of the stock market, which is why I love it when people start asking me this question. When they start asking me if the stock market is worth it anymore and whether they'd be better off holding cash, this tells me that the future for the stock market is looking brighter than it did before. If after watching all this, you're still tempted to hold cash and wait to see if the stock market falls further, you need to watch this video here where I show you why holding cash to try and buy the dip is also a terrible idea. I'll see you there.